Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast. I've got Chuck and Mark. Now we're going to quote an old song lyric here. Some of you will know this. Meet the new boss, same as the old boss. And that is a quote from The Who. And if you don't know the song, dear God, first off, you might be way too young to be listening to this podcast. But most importantly, just go on the radio and listen to this amazing song, because it's really amazing. But here's the best part about it is this is wildly applicable to what's going on today. Chuck, I'm turning it over to you, brother. What do we got?
Hey, thanks, Matt. Well, you teed it up really well, and you got it. The Who, British rock group, right, kind of span that late 60s, 70s era. Pete Townsend, kind of they'll call him a street fighter type of guy, right? He wrote a song called We Won't Get Fooled Again, right? And the lyric that you quoted, the meet the new boss, same as the old boss. But we were talking in the green room prior to this just about politics and how frustrating it is. And Townsend writes this song because there's a line in the song where he says, meet the party on the left, they're like the party on the right, nothing gets done. And whether you believe his political viewpoints or not, there's one line in the song, meet the new boss, the same as the old boss. So we felt as though we could relate this to the investment world in that the old boss value companies are the new boss. And we've lived through the last decade where easy money, that's ZIRP, zero interest rate policy in the US, NIRP, negative interest rate policy globally, and certainly low inflation caused by globalization has run its course. And fundamentals matter, valuation matters. And the beauty of this is that, and this is where I'm going to tee up for Mark, is that Nepsis saw this happening 2 years ago. We began to traditionally move from what were the growth lockdown plays into more value-oriented growth at a reasonable price, let's call it. And we were running that for the last 2 years. We think this is a systemic change, and we're going to accentuate our belief by this podcast, and the new boss value is the same as the old boss. So, Mark, why don't we talk a little bit about maybe some of the process and unearthing growth at a reasonable price and how we see the world unfolding from this point forward?
Sure. Well, obviously, first of all, this year has been on many levels extremely frustrating for many investors, and not a lot has worked to make money in 2022. In fact, the only two sectors that really have been successful have been energy and select healthcare. And we happen to have over half of our portfolio in our top 10 holdings in those two sectors. And that whole process really did start about 2 years ago. And I always tell clients, because clients are very emotional, investors are very emotional, and they look at a screen and they make an assessment about the value of something when they see the screen. And the reality is there's no value until you sell an investment. There's no gain, there's no loss until you sell. And when you look at what's happened in 2022, while we're down significantly less than the markets and significantly less than most people are down way more than the markets, because bonds are down big. And from what I hear on the street, people are down 30 to 40%. And that's because they owned a lot of growth stocks. And we got out of a lot of that a year to 2 years ago and started buying value, overweighting value 2 years ago. And we do think longer term, that's what's going to happen. And so we own a lot of energy. We own a lot of healthcare. We own a lot of financial too, which is also considered value. It's been a crazy, as we're doing this podcast, the markets tanked on the CPI information this morning, and now the markets are up big. Maybe we've
only to rebound, right?
Yeah, maybe we've bottomed. Who knows?
Yeah.
But I do think we're in a different world, and meeting the new boss is same as the old boss is very apropos in this process. Now, let me make one last point. to finish on investors being emotional. The decisions that are allowing us to be successful at any given time, for the most part, are decisions that are made 1 to 3 years previous. We're long-term investors in great businesses, and we use volatility as an opportunity to buy more of those businesses over time. And we have plenty of dogs in our portfolio right now, short-term, but we've also been able to buy more of them on sale at cheaper prices because we're looking at 3 years from now, 5 years from now, what the value of those businesses are going to be. And the reality is that many people that listen to this podcast don't even know what businesses they own because they own a bunch of ETF
Exactly.
ones. And so when you don't have clarity in what you own and why you own it, it freezes you from making decisions. And so I'm extremely pleased and happy with where we are in the decisions we made 2 years ago, selling businesses that we bought 3, 4, 5 years ago, right? So
Absolutely.
That's a long-winded answer to your question, but I'll let you take over.
Yeah, thanks. I think it was a great tee up to this piece. So it's kind of new boss, old boss. What are we talking about here? So when you measure returns, you want to do them to be more precise on what we call a rolling average. And a rolling average basically says that you have a point in time, point A and point B, and you move a day into the future, you lop off the first day of your database. So that's what a rolling average is. It takes the skewness out of the top and bottom. Now, why am I mentioning that? You go all the way back, and Mark, this is where we chronicle this to 1930. So we're talking 90 plus years ago. There has only been 3 periods greater than 1 year where quote unquote growth stocks, so meaning higher price to book, higher price to earnings, lower dividend, whatever factors you want to use to describe growth. But growth tend to be a fledgling business, right, that has the new mousetrap, right? You can think of maybe historically an Amazon or a Tesla, right, over the last 10 years when they were growing, they weren't profitable, they were flooding every dollar they could make back into building the mousetrap globally. So the reason I mention that is because you've had 3 periods. Here are the 3 periods, Mark. You had 4 years during the Great Depression from 1936 to 1940 where growth outperformed. Why? We were in a depression. We had zero growth, zero inflation, and we also had interest rates that were close to zero. You buy growth when the economy's void of growth. Think about this, Mark, from 1940 up to 1998. That's 58 years of rolling time frames, 10-year time frames.
Yep.
Get to 98 and 99, you have growth outperforming again for 2 years because of the tech bubble. Yep. Fast forward to 2010, value outperforms. It's the last decade really was the only period of extended time frame where growth outperformed value. Now, why was that? And we're going to unearth that, but I'd like for you to speak about when you recognize patterns like this, that we actually did own growth. We owned international. We let the markets unfold for themselves, but we found value in those companies. Hey, look, if companies can borrow at close to zero, why not own some of those growth businesses? If inflation's close to zero,
right,
that's the place to be. And
well,
that's
yeah. So to take it to a different level, even is I've always said 2 things: value is relative,
absolutely,
not absolute. So you can have a growth stock, what's categorized, and it's just categorized as a growth stock. And what categorizes a growth stock? The metrics are used to value a growth stock are different than the metrics that are used to value a value stock. And all value and growth stocks are buckets. They're categories that the industry has decided to call growth stocks growth, value stocks value. And so the value of a growth stock is relative. The value of a value stock is relative, but there are certain components that go into the valuation metrics. In a dovish Fed, in a Fed that is accommodative, in a Fed that is putting money into the system,
you got it,
increasing liquidity, it means that people have easier access to capital, which makes valuations of anything, any asset you want to buy or sell, change. Look at the real estate market. Houses have gone up in value extensively because interest rates were lower. Now interest rates are going back up. That growth of the real estate will slow down because people had easier qualifying measurements to purchase a more expensive house. In the stock world, when companies need to raise capital, when it's cheap money, the cost of that capital is cheaper.
Yeah, exactly.
And we don't have an accommodative Fed. And I do think we are getting out of a period where the markets are going to go back to what I would call historical measures, value companies. When grandma and grandpa and mom and dad had a stockbroker and they bought stocks, they didn't buy ETFs and mutual funds.
Exactly.
They bought into companies and value mattered. Value stocks are valued based on actual earnings, money going into the bank. They are valued on their dividends. No one's talked about dividends forever. But history will dictate that dividends make up a significant portion of total stock market returns. And I used to just laugh at myself, when I would hear friends and people talk about how much money they made on all these stocks, and they feel super genius because they bought DocuSign or they bought pet.com back in the day or whatever, and they made all this money super quick only to see it all go away. And the reality is that value actually does matter. And it's understanding the value metrics of any company you want to own and the comparables of other businesses in that industry. And I don't know, price to earnings ratio, no one talks about anymore until now when it actually matters. And everyone's now starting to talk about what we started talking about a year ago, which is PE is going to matter. Price to earnings ratio.
Precisely.
And I don't know what the average price to earnings ratio is our portfolios today because everything's all over the place, but I'm guessing it's around 8 or 9 times earnings. Is that right, Chuck?
Yeah, remember we ran it last week and it was just slightly above 10, but you're right, with the downdraft, we're probably in a high single digit right now as we speak.
As valuation. So as the markets are going up now, we obviously do far better. But my point is valuation is going to matter, and value is relative. Valuation is relative. Understand the metrics of why you actually make the decisions on the companies you own, and then take it a step further and understand the asset allocation strategy of your portfolio. Understand how every single company in your portfolio and our client's portfolio is there for a very specific reason. I don't care if it's a dog stock or it's a great stock. If it's made money in the short term, lost money in the short term, made money in the long term, lost money in the long term, I don't care. Every position is owned for a specific reason to accomplish an overall asset allocation strategy, period.
Mark, you allowed, again, a great transition to this particular next part of the segment here. I wanted to unpack the reason why, as you said, we had such low inflation, such low interest rates, and why the pendulum is swaying back to normalcy. So let's take a little bit of maybe 3 or 4 minutes just to allow me to do this, because the crack research team, we should call us, Mark.
Absolutely. Hey, the research team is at it. Go for it.
And we're headquartered in Ogallala, Nebraska.
Nebraska, right. Yes.
So, nonetheless, here's what we unearthed. Go all the way back, if you can, in the memory banks to 1989. We had the dismantling of the Berlin Wall. We had the fall of what we used to call the USSR, right? The United Soviet Socialist Republic, the Soviet Union. And in essence, Eastern Europe and Germany, which was East and West Germany, opened itself up to capitalism. We had then in 1993, the NAFTA agreement signed between the United States, Canada, and Mexico, unfettered trade with our border countries. We then had China, which actually played the choir boy for a decade of the 90s, admitted into the World Trade Organization in 2001. We literally had a détente, if you will, globally. Really, Cuba and North Korea are the only countries not participating in this globalization phenomenon. So what we had were 2 things: low inflation, right? We had outsourcing of jobs, factories, both to Southeast Asia and certainly from Western Europe to Eastern Europe, brought down the costs of goods. But here's the key, Mark. We had this coordinated central bank effort to bring rates as low as possible. Now, why would you? If you're in a global trade environment, the lowest valued currency wins. Now, what is win? It wins the trade battle because the companies, right, in your country have a weakened currency. They can sell more stuff to the foreign purchaser. Those have both unwound, right? We've had COVID, which changed the way we trust just traveling and getting a virus and possibly dying from it. We've had both choir boys, Russia and China, just now become the bad actors. We're resourcing, right, back to Europe and the United States, those factories and those jobs, higher inflation, back to normal, maybe 3.5%. And now I want you to take it from here. Central banks, which really over the last year decade brought rates down to zero or negative, have realized, hey, we can create inflation and the public hates it. They're not going back to that. So we're now in the world that our grandparents and our parents lived, where fundamentals matter, where valuation matters. And I wanted to just talk a little bit about maybe some of the companies, or at least the process, and it's relative, what we look at when we're looking at buying a business in this environment of higher interest rates, less global trade, and certainly higher inflation. What would you look at for a company, and what has that led us to in our portfolios?
Well, first of all, one of the mistakes that investors make is they say, well, gee, my portfolio was up 10% this year, and that's great. There's a rate of return on your portfolio, and then there's actually what's referred to as your buying power. Is your rate of return minus the cost of goods and services you have to pay for. So the net rate of return, real rate of return, is gross return minus cost of goods and services that you have to pay for. Therefore, no matter you're in a high inflation environment or a low inflation environment we came out of, the reality is that the decisions that you make and the kind of businesses you want to own will change in a low interest rate environment than in a high interest rate environment or in a high inflationary environment. And that is what's called pricing power. I had a brain melt there.
It's okay. I was going to write there for you. The pricing, like the double P, right? Almost like we got the triple P. This is the double P, pricing power.
Yeah. It's pricing power.
Right.
So when you look at companies that are working right now, food companies, gasoline,
right,
gas, oil, healthcare, these are all businesses that have the ability to raise prices
exactly
to keep up with inflation. So their earnings can keep pace with the inflation. Now, there may be a catch-up period in there, but what you're looking for are businesses that have the ability to change prices. Look at the food prices. We're a big owner of General Mills. Look at what General Mills earnings just came out. They killed it. Companies that have pricing power are going to survive in an inflationary environment. Companies that are not making money, which have to borrow more money to get profitable, their cost of borrowing goes up. And in the process of their cost of borrowing going up, that means they're going to be less profitable or take longer to be profitable. You want to own businesses that have pricing power. You want to own businesses that people need. We're big holders of insurance companies, financials, along with energy and healthcare. Those are our three biggest areas. Visa and MasterCard are great examples. They get paid 1% on every transaction. So they don't care what the price of price of the thing is. But guess what? If the prices have gone up, their fee percent's the same, but they're making more money.
Absolutely.
And so these are things you want to think about when you look at the companies you want to own as part of your asset allocation strategy.
Mark, excellent. So we got to think about 5 to 6 minutes left here, and I'm going to throw one at you here, but I'm going to back into this because ultimately I want you to speak to the PEG ratio. And I love when you say these are relative. They are. And I don't want our audience to leave not understanding that part. So I'm going to lay this one out here for everyone. There's a rule and these rules are rules of thumb, but we've all heard of the rule of 72 before, right? That's, hey, if I earn 6% in a given investment, how many years will it take to double my money? You divide 6 into 72, you get 12 years. And it's a rule of thumb because it doesn't work at the extremes, but it certainly works. I mean, if you had 1 year and you earned 72%, you didn't double your money, so it didn't meet that rule of 72. But here's a rule that we use, Mark, kind of in our industry. We call it the rule of 20. So basically what it's doing is it's taking the number 20, subtracting the inflation rate, or it's called the anticipated inflation rate, and that gives you the PE. So historically, this going back to 1940, again, the crack research team, right, 1914, the average rate of inflation is 3.3%. Now, we just printed an 8.3. It's coming down. We'll probably get, let's say we get to the average, 20 minus 3.3 is 16.7. So give the audience kind of a flair for, that's what the historic PE's been. We're maybe at 10, but we're looking for this GARP business, growth at a reasonable price. We just don't want to own a stale business just because it has a 10 PE, but talk about how we want the growth rate to be nearly the earnings growth rate where that PE is, and how that balance works when we choose companies. And we're going to end this baby today.
So first of all, asset allocation is number one priority. We own a lot of different businesses in the portfolio at a specific percentage rate for a specific reason to accomplish a long-term goal. So we have a few companies in our portfolio that aren't making money right now. They won't down the road, but they're not right now. But it's got, as fiduciaries, we have to asset allocate. We're overweight value versus growth, but we call our growth companies growth at a reasonable price.
Excellent.
And you mentioned PEG ratio. PEG is the PE ratio divided by the growth. And I'm not going to give away all of our sauce on how we make decisions in terms of what types of companies we have, because there's a lot of businesses out there that are what's referred to as value traps.
Right, exactly.
Value traps are companies that have low PE ratios, but they also have no growth rate. And so if you don't have growth, a low PE doesn't really matter.
Doesn't matter.
Ultimately, people do pay for growth, and that's why the PEG ratio becomes important. Price to earnings ratio divided by growth rate. So a lot of the businesses that we own have PEG ratios that are low, PE ratios that are low, and they have high dividend yields.
Exactly.
So talk about the magic elixir, right?
Yeah.
While everything is going down, we're still getting paid lots of dividends, and we will see the value come out of these great businesses long term, because wealth is created over time, not overnight. People get impatient. People expect to be rich overnight, and that's just not going to be the case. You got to stick to the knitting. You got to stick to the process. And so a lot of the companies we own have not only low PE ratios, but they have great PEG ratios.
Exactly.
And that means that we believe that their growth rate is going to continue to be strong or get stronger. And that is one of the metrics we use when we look at the businesses that we want to own.
Mark, I love it. I think another good one here, Matt, wouldn't you say so?
It's unbelievable sitting here listening for a number of reasons. The first reason is because you guys go on these highly technical explanations of things, and then you bring it back to, oh, okay, I'm not the brightest guy in the world. I actually understand what you guys are saying. And I really personally appreciate that as a consumer of your content, because I like the idea of you guys being able to show how much depth of thought goes into what you do, but then still be able to communicate to Joe on the street, me, on what you're actually talking about and what you're thinking about and why it's applicable.
I actually appreciate that. We just did our first webinar for prospective clients last week, and the response by very smart people, successful people who sat on the webinar, told the advisor that set them into the webinar that exact same thing, that they could actually understand with common sense what we're talking about. Part of the reason why I think investors are afraid, they bury their heads and they're afraid to talk about their investments, their portfolios, because they just flat out don't understand it. And the reality is you're a business owner. And a lot of people aren't business owners and don't know what it means to be a business owner and don't understand all the metrics of running a successful business. And so they have a tendency to bury their head and not look at it, not think about it, not talk about it, not ask questions, etc. And what we do try to do with Investing with Clarity is break it down in common sense to the public who can understand it. And so That's a great compliment. Thank you.
And just to wrap this up today, the idea that most people don't realize they're business owners, number one. Two, they don't know what they own and why they own it. And three, that their portfolio isn't built with specific things in that portfolio to solve specific problems, right? That is the issue. And that's why having clarity is so vitally important. All right, everybody, if you have not subscribed to the show, make sure that you do. Make sure that you go to the Invest with Clarity website and find out how you too can engage with a Nepsis advisor to find out a little bit more about how you can have more clarity. So for Chuck and for Mark, this is Matt Halloran. We'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC registered investment advisor.